Good afternoon. Thank you, Jeff, for that very kind introduction. And thank you as well to the CFA Institute for the invitation to speak to you here today. As you heard, like many of you, I went through that 3-year grind to achieve this designation. In my remarks today, I'm going to talk about the bank's market operations. And I think this may provide an opportunity for some of you to revisit some of the fixed income basics that we learned getting our CFAs. Many of you invest, raise funds, or analyze markets, so I'm sure that you follow the Bank of Canada's monetary policy rate announcements. I spent many years during my career in a trading room, and I witnessed firsthand how quickly markets adjust and react to changes in the policy stance and the target rate. As they do so, they help the Bank of Canada fulfill its two main responsibilities: the implementation of monetary policy and the promotion of the stability and efficiency in the financial system. Today, as Deputy Governor at the bank, observing how quickly and smoothly markets adjust confirms to me that the framework that the bank is using is working well. But markets are dynamic, and the financial ecosystem is in flux. Like living ecosystems, it is constantly evolving and adapting to change. It's important for us to be alert to shifts in its structure in order to help support its smooth and efficient functioning. We aim to be proactive and to respond to its evolution in a considered and calibrated fashion. In my remarks, I'll discuss the shifts that we are seeing in financial markets and highlight the changes that we are proposing to fine-tune our operations. We recently posted on our website a consultation paper that discusses and details the proposals that I will outline today. We are consulting market participants like you in order to ensure that the changes meet our intended objectives as well as being implemented seamlessly. A second consultation paper on modifications that we are proposing to support financial stability has also been posted. Both of these were discussed by my colleague, Senior Deputy Governor Carolyn Wilkins, last week in Montreal. As I briefly touched on, the behavior of market participants and the financial system are evolving. This is a result in part of lessons learned during the global crisis. Those lessons prompted regulatory changes to address weaknesses that were identified. As a result, financial institutions have adjusted their operations, including how they manage their liquidity needs. In Canada, liquidity across the system is typically been distributed by the major banks and dealers. At present, there are 15 participating Canadian financial institutions in Canada's main large value payment system. These firms have accounts at the Bank of Canada, and they execute payments with each other throughout the day. But primary dealers are the main counterparties to the bank for its market operations. They can access and redistribute central bank liquidity more broadly in the normal course of business. Over the past few years, we've observed that financial institutions have become somewhat less willing to borrow extra liquidity through our operations and redistribute it to others. It appears that they have become more focused on meeting their own liquidity needs. In addition, with the new Basel III regulations requiring institutions to hold high-quality liquid assets to withstand liquidity shocks, demand for these assets has also increased. And many banks are rationalizing the use of their balance sheet, moving away from balance sheet intensive and low margin business lines. Given all these changes, we've been reviewing our operating framework to assess its effectiveness. Let me describe how that works. The bank undertakes a range of financial market operations in the course of fulfilling our monetary policy and financial system responsibilities. Our operations are in 4 main areas, and they include transactions to reinforce the target for the overnight rate, to provide liquidity to financial system participants, to acquire and manage assets for the bank's balance sheet, and to lend a portion of the securities that we hold. Overall, our market operations framework is intended to achieve our policy objectives while minimizing our footprint in markets. As you may know, we announce our policy rate decisions 8 times a year on fixed dates. This rate, in combination with expectations about our future policy stance and other factors, influences pricing along the entire yield curve, as well as a range of other asset prices. These, in turn, have a material impact on the economic decisions by households and businesses. Ideally, we prefer that the overnight rate is cleared on its own at the target rate through market forces rather than through our operations. We encourage this with an interest rate corridor. It's reinforced by standing deposit and lending facilities available to the participants in the payment system. This corridor helps drive them to clear at the midpoint, which is the target rate. That's the theory, and it does work well in practice. However, there can be frictions. For example, sometimes the interest rate that is transacted in the overnight market starts to move off the target during the day. The bank will typically intervene if it judges that this deviation is the result of generalized pressures on liquidity in the overnight market rather than firm-specific reasons. For such intraday frictions, the bank can use repurchase or repo transactions to add or withdraw intraday liquidity to or from the system to offset these pressures. So how can we reduce the frictions and help enhance the flow of liquidity? We are proposing to adjust the format of these repo operations from being fixed at the target rate to a competitive price auction at market rates. We will increase both the aggregate amount of each repo operation and the limit for each counterparty. These changes will allow firms that need liquidity to bid for a higher amount in any given round. We expect that this will help distribute liquidity more efficiently to those that need it most. At the same time, we may accept larger deviations from the target rate before we step in. Doing so will give the market more time to maneuver and clear itself without our intervention. These, then, are the main proposed changes to our operations to reinforce the target for the overnight rate. Now, I'm going to turn to some of the enhancements that we are proposing to support the well-functioning markets. An important part of how we participate in markets is through the management of our balance sheet. So let me take a couple minutes to describe that to you. Like any company, central banks have balance sheets that need to be managed. At the Bank of Canada, our largest liabilities are banknotes in circulation and deposits from the federal government, which are mainly backed by the assets in our investment portfolio. Almost all of the $94 billion in assets held on our balance sheet consist of Government of Canada, Treasury bills, and bonds. These are acquired on a regular basis through primary market purchases. We follow 3 principles in acquiring these assets: prudence, transparency, and neutrality. Prudence is exercised primarily by selecting assets that have low credit risk. We achieve transparency by communicating our balance sheet activities to the public. And to attain neutrality, we act as broadly and neutrally as possible to limit the market distortions from our investment activities. At present, the composition of the bank's portfolio broadly reflects the composition of the federal government's domestic debt. Going forward, the volume of banknotes in circulation will continue to grow roughly in line with the growth of nominal GDP. This will increase the bank's asset requirements. At the same time, market demand for Government of Canada securities is also increasing. For example, the proportion of federal government debt held by non-residents has increased steadily. It has gone from almost 15% in 2006 to just over 25% in 2014. One of the factors that's underlying this increase is that the Canadian dollar has become a more commonly held reserve currency in other countries. Another factor is the Basel III regulations that I mentioned earlier, which requires banks to hold more high-quality liquid assets. Since government securities are among the safest and most liquid assets available, they have become more desirable. This is why in Canada, federal government securities account for the majority of the collateral used in the repo market. Given these pressures and the expected growth of the bank's balance sheet, absent any other changes, we would have to buy a growing share of the stock of government securities. This would clearly reduce the tradable float. Taken together, all of these factors could intensify liquidity pressures in the Government of Canada repo and cash markets. Indeed, we have already seen some signs of this. The bank has had to lend securities from its balance sheet to alleviate short-term imbalances in demand and supply more frequently over the past few years. Recognizing this shifting dynamic, we are proposing several enhancements to help support well-functioning markets. The first enhancement is the introduction of regular term repos. We anticipate that the conduct of money market operations at longer maturities will not detract from our ability to influence the overnight rate. Term repos will be useful to us from a policy perspective. They will help the bank gather intelligence and analyze changes in liquidity conditions in short-term funding markets. In addition, they may encourage further development in longer-term repo market in Canada. And conducting term repos on a routine basis will facilitate a quick response to future market-wide liquidity shocks. Term repos will serve as a source of short-term assets for the bank's balance sheet. This will allow us to decrease our presence in the primary market for Government of Canada securities. We are proposing to commence these term repo operations in the latter half of this year. Our plan is for a 6-month phase-in to reach a steady-state portfolio of $7 to $10 billion. This would amount to roughly 10% of the bank's balance sheet. Enhancement number 2 is a shift to the secondary market for some of the bank's purchases of Government of Canada securities, primarily non-benchmark bonds. Currently, the bank's primary market purchases of bonds amounts to 20% of every bond auction. The introduction of term repos and secondary market purchases will enable us to reduce our purchases at the primary bond auctions to what we expect will be around 10%. Using 2014 issuance figures, this would amount to an increase of approximately $9 billion in tradable float available across the benchmarks. Our intent is to enhance liquidity in these benchmark securities by holding fewer of them, leaving more available to other buyers. Benchmark securities play a unique role in financial markets because they are used to price and hedge a variety of cash and derivative instruments. The bank will maintain the maturity structure of the securities it purchases roughly in line with the profile of the government debt outstanding. And the third enhancement is a change to some of the parameters of our existing securities lending activities. Since 2002, the bank has operated a program to lend a portion of its holding when a specific bond or treasury bill is in high demand and is otherwise unavailable or trading below a certain threshold in the repo market. Lending our holdings provides a secondary source of liquidity which helps maintain a well-functioning market. The program is designed to support efficient clearing and price discovery. However, since 2013, a growing number of Government of Canada bonds have been trading at repo rates persistently below the overnight general collateral rate. As a result, the frequency of the bank's securities lending has increased considerably. Repo tightness typically reflects an imbalance between the demand for and availability of certain securities in the repo market. Protracted repo tightness can affect the cash prices of these bonds and contribute to a reduction in market liquidity. It can also increase its settlement fails where one party is unable to deliver the securities promised to its counterparty. To help support market liquidity, the bank is proposing changes to the intervention threshold for its securities lending. At the moment, it appears that the bank's existing threshold is setting a de facto floor on market repo rates. In some circumstances, the rate does not seem to be low enough to induce sufficient lending from private sector borrowers to meet demand. A lower threshold could help clear the market, while the bank's program would remain available to primary dealers as a backstop. The goal is to encourage Government of Canada securities holders, which may include not only domestic investors but also other central banks or sovereign wealth funds, to lend out their holdings before the bank has to intervene. We act as custodian for 30 central banks and are currently implementing a number of measures that will allow them to more actively trade their portfolios, including in the repo market. Another element that we are proposing is the introduction of a market-wide fail fee. Our own securities lending program already includes such a fee. We're seeking feedback on whether the market should impose this kind of levy on trades and securities that fail to settle on time, as is now the case in the United States. The main purpose for adopting it would be to reduce the risk of settlement fails and provide investors with additional financial incentives to lend securities that are in short supply. Finally, after reviewing some of the ways that we dealt with short-term funding needs during the crisis, we are proposing to develop a contingent term repo facility. This will enhance our ability to respond to future episodes of intense market-wide stress. The facility would be activated at the bank's discretion only when conditions warrant. Establishing this facility will ensure that the bank has a permanent and flexible range of extraordinary liquidity facilities in place. It could be activated to help respond to and alleviate system-wide liquidity pressures. The CTRF would offer liquidity on a bilateral basis for customized variable terms of up to 1 month. It would be available to a range of counterparties against a broad set of securities at a fixed price. The specific parameters would be confirmed upon activation. We expect that if the CTRF were activated, the counterparties eligible would be primary dealers and their affiliates. However, the number of counterparties could be extended to include other institutions subject to certain criteria, should the bank consider it necessary for the stability of the Canadian financial system. Let me wrap up by reiterating that the bank's operating framework is working well. We monitor our market operations closely to ensure that they are contributing to the maintenance and diversity of the financial ecosystem. Bearing in mind that a healthy system will feed economic growth, we have identified important areas for improvement. We think carefully about making changes to our framework because we recognize that doing so will affect markets. We want to make sure that any changes are well thought out and include feedback gathered from market participants like you. The adjustments that I have outlined are in response to changes that we are witnessing in financial markets. In addition to helping us achieve our framework objectives, they will benefit all market participants. Thank you.
Thanks for those comments, Lynn, and we'll now take questions. I'd like to welcome Richard Detman up to moderate the Q&A.
Oh, please take the mic here. I'll just stand off to the side. First of all, thanks to the CFA for having me in today. And we have several questions from the audience. If one comes to your mind, just write it down and bring it up to perhaps to Jeff here, and then get up to me, or you can just bring it up to me. That'll be fine. Let's start with the central topic here. I'll find it here. There it is. So with respect to the consultation on monetary policy released last week, does the bank feel that the proposed changes to the repo operations would actually reduce liquidity, and what would be the effect on bonds of terms shorter than 5 years? Because you talked about longer terms.
Well, first of all, the two consultation papers, one is specific to what we're doing on the emergency lending side. The other is specific to what I've spoken about today. And we believe that these changes will all help to enhance liquidity in the government securities market, given the changes that we're making, irrespective of term. Just to add a few more comments with respect to our longer-term repo activity, we will be looking to finalize details of that over the coming months, but we'll likely go out into the 1 and 3 month area of the curve for those activities. Specifically to the secondary market purchases, we will be focusing on continuing to replicate basically the maturity profile of the government debt. So we will do that in the secondary market through non-benchmark bonds so that we're not putting more pressure on benchmarks. So I think overall the package is intended to enhance liquidity for government securities. Okay, so just a couple other things I can add on, first of all. So with respect to the point about non-benchmarks that are already trading special, and our intent is not to try to exacerbate a situation that's already in place. So certainly if there were specific parts of the curve that had non-benchmarks that were already under stress, we would not be adding to that stress. That is certainly not our intent. And sorry, the other part of your question, with respect to the level at which there may be activity, we have now this consultation paper out there for all market participants, as I mentioned, to give us feedback. So that will be open until early July. So certainly, the team in Ottawa would be very delighted to get your comments on that. But what we're trying to do is entice some other participants in the market that have been reluctant because the rate hasn't been special enough, so to speak, to come in and provide some liquidity. We will obviously continue to be there with our own portfolio to alleviate tightness as we see it. You're welcome.
Ms. Patterson, has the bank considered buying assets other than Government of Canada's, or is that too risky? We are constantly looking at all of the options available to us, but at this point in time, we feel that we can meet the demands of our balance sheet requirements with the term repo, as we have outlined today, as well as with secondary purchases of Government of Canada bonds. So at this point, no. Is the bank considering a change to its inflation target?
He asked that just like he asked the question about bonds. That was very smooth. Every 5 years, the Bank of Canada reviews its inflation target agreement with the federal government. And so the next renewal date for that agreement is in 2016. So as of last fall, we actually kind of kicked off formally with a speech by my colleague, Deputy Governor Gat Cote, in November of last year, discussion about the inflation target renewal. So I would encourage any of you that are interested to look at the website and read her speech. As well, we have a dedicated page on our website now with respect to the research around the inflation target renewal. So we're obviously looking at things very seriously in this space. We have had the current inflation target in place for 20 years, and clearly the bar is extremely high for change. Some of the most recent comments that have come out have really been a result of what we have been living through globally for the past 5 years, where it's been difficult to achieve inflation targets, and in some countries we've seen the zero lower bound come into play. So it's part of our exercise. It's certainly part of the research agenda. Aside from what is the appropriate level of the inflation target, we also have a couple of other specific inflation-related topics that we're looking at. And one is, how do we measure core inflation? What's the best way to measure that? And also looking at the important interplay between financial stability and price stability.
A couple of questions then related to the continuing record or near low record interest rates. Does the bank consider the effects of those rates, those low rates, on the funded status of pension plans?
Well, I think in the span of our responsibilities and looking at financial stability issues, that is something that we take into account. I'll put a plug in here for the Financial System Review, which we put out twice a year, which will be out June 11th. Not that this is a specific topic of it, but that is when we do our holistic view of financial system risks for the country. But, you know, the low interest rate environment is really, at this point in time, to achieve our primary objective, which is to meet our inflation target of 2%. So that is what drives our interest rate decisions.
Sort of two sides of the same coin here. To what extent is the Bank of Canada concerned if the rising consumer debt levels? Pardon me, I've got some writing issues here. Levels
continues to be lower.
Yeah, it's the issue of do continuing low interest rates fuel the record high levels of debt. And the other side of that, from another questioner, is what's your view on the potential impact of rising rates on the ability of Canadians to service those record debt levels?
Okay. Well, we didn't even plan this, but this is all great plugs for the Financial System Review that's coming out in June. So, of course, all of these issues are important to us. You know, the current level of interest rates is in some ways impacting debt levels, and we're aware of that. Certainly, with respect to our last interest rate decline in response to the oil price shock, part of that lower rate would in fact alleviate some of the pressures for debt holders with respect to part of that equation, of course. So, you know, again, our interest rate is really our element and instrument in order to achieve our 2% inflation target. And that is our primary objective. We would certainly suggest that there are a few other lines of defense with respect to both borrowers and lenders with respect to their own activity, as well as regulatory environment.
How does the bank account for commodity price fluctuations in its forecast?
Yes, so we do not forecast commodity prices. What we do in our horizon for our modeling is look at a recent range of prices for the set of commodities, and we assume that price range over the life of our horizon, which is 8 quarters, so 2 years. So as of the last NPR in April, our assumption for Brent at that time was $55. So we're obviously tracking above that at this point in time. But similar on the currency, neither oil prices nor the currency level do we forecast. We just take an assumption of the most recent data and we carry that through our model for the entire 2 years.
We're in Vancouver, so let's talk about housing. Are the Vancouver and Toronto housing markets a wild card or an outlier when considering monetary policy?
Geez, those are some strong adjectives. What I would say about housing is that we continue to anticipate, on an aggregate basis for the country, a soft landing. Certainly Vancouver and Toronto are showing some very robust activity. And, I think there's some specific reasons in both of those regions as to why we're seeing that. So we don't forecast any specific cities, and so I can't really comment any more than that.
That's it.
Okay, thank you all. Good questions, and I'll be around afterwards if anybody wants to catch me for something else.